Hey, what's going on, everyone? I hope everyone's having a very awesome week. This week's video is going to touch on the inverse relationship that bond prices have with the current prevailing interest rates in the market. Now, it might be a little confusing to think of the negative correlation between current bond prices and the interest rates. But once you kind of take a little deeper look into it, it does make a little more sense as to why they have an inverse relationship. When one goes up, the other goes down, and vice versa. When one goes down, the other goes up. And they are always based on the interest rates of the market. So let's take, for example, you have a bond that you bought at $1,000, which was issued this year. And let's say the current interest rates this year, when the bond is issued, is 2%. 2% interest return on that $1,000 bond will get you a $20 return simply for purchasing this bond. You will get interest payments from buying this bond. That interest payment total will be $20. 2% of $1,000 is $20. Now, let's say you hold this bond for a year, you own this bond for a year, and let's say exactly a year later, interest rates in the market rise to 3%. Your bond was issued at 2%. It is still paying you, no matter what the interest rates are. If it's a fixed interest rate payment, it'll pay you that $20 no matter what. However, because interest rates rise to 3%, bonds that are being issued at this 3% rate are giving a return of $30, while the current bond that you hold is only giving you $20. These bonds giving a $30 return look a lot better than the bond that you hold that's only giving a $20 return, pushing the value of your bond down. Now, let's take it back. Now, let's say you still have that bond issued at 2% for $1,000 issued at 2%, paying you a $20 interest. Let's say instead of interest rates rising to 3%, this time interest rates are going to drop to 1%. These bonds issued at the 1% rate are going to be paying $10 annually to their bondholders. Your bond is paying 20 while these are paying 10. Your bond looks a lot more attractive to investors than a bond paying $10 compared to yours paying 20. That's what pushes up the price of this bond for you as the holder. Your bond looks a lot more attractive, therefore you can ask for a higher price when selling in the market. We usually don't talk about bonds, guys. They're not as sexy or as fun as stocks or gold or even, current cryptocurrencies. However, they are a very safe investment, mainly if they're being issued by the U.S. government. The U.S. government issues bonds, corporations issue bonds, even municipalities issue bonds. However, the full faith of the U.S. government is backed into treasury bonds. That's why they're considered the safest type of investment. That's right, the safest type of investment. You put your money there, as long as the United States government is still intact and still has its sovereignty, you will get your money back on these treasury bonds. Whenever you hear that interest rates are rising or falling, just a general rule of thumb, you can know that bond prices in the current market that were issued at the old current interest rate, but now there's a new one, it will change inversely compared to how the interest rates are going. That's a little bit of the negative correlation that bond prices have with the current interest rates in the market, guys. If there's any questions, please feel free to leave them in the comments. Have a great week.